Welcome back to Money Talks. I'm Roderick Jefferson, financial advisor, and I've been helping people build wealth for over a decade now. And today we're going to talk about part 2 of our series, Investing in 2021. If you missed part 1 of my series, please go back to my channel and check it out. In there we talked about the type of stocks that are available to you as an investor and the platforms that you can invest on. Today we're going to build on that and get into investment behavior, into diversification and allocation of your portfolio. All of these are key pieces that fit together in that puzzle that make up your portfolio. So stick around and let's go. Today what we're going to focus on is investment behavior, diversification of your portfolio, and allocation of your portfolio. These are all very key pieces that fit together to make that puzzle work and build your portfolio so that way it can weather the storms of the ups and the downs and even some of the storms that just take place in your mind. Investment behavior, what's that? Basically, your emotions. Yeah, I'm talking to you. You know who you are. Your emotions determine a lot of things in life, even your finances, how you spend money, and how you invest. Typically, when the market is going up, we call that a period of euphoria, when it's going up and up and up. And some people say, oh, it's going to come down, and it keeps going up. That's a period of euphoria, excitement. And everyone wants to get in and get invested and buy stocks. Well, who doesn't love that period? It's when the market starts to come down, we start to tell ourselves like, no, stick with it, stay with my investment. But ultimately, as the market continues to go down, the retail investor typically sells their investments at the bottom. And this is the opposite of what you're supposed to do. Some of you might be saying to yourselves, no, not me. I would never do that. But statistics have proven that investors do not perform as well as the S&P 500, not because the investments are not the same. They don't perform as well because we are human and we have emotions, and we tend to sell when things are at the bottom, and we tend to buy when things are at the top. Now I understand that as the market starts to come down, it's very difficult to hold on to your investments because you're looking at your money, or you're looking at the value of your account, and you're thinking about how hard you work for that money. So it's tough to see that value decrease. The key to it is to stay invested and stick to your goal. That's why in our last video we talked about having a goal, setting your goal, and building your investments around your goal, which determines the strategy that you're going to take. So you're not going to use investments that may be too aggressive for what you're trying to accomplish. So one of our first steps that we want to make sure we put in place is, one, check yourself. Control your emotions. Stick to your plan, stick to your strategy. These are all things you set up before you actually bought your first investment. So once you get control of your emotions, now we can talk about what is diversification. Many of you have heard the term, don't put all your eggs in one basket. Well, basically what that means is if you drop the basket, you lose all your eggs. When it comes to investing, it's very similar. You don't want to put all of your money into one stock or one particular sector of the market. So not all in tech. Some of it should be in retail. Some of it should be in consumer discretionary. The reason you do this is because if one sector performs well and another doesn't, you have your money split up so that way you can benefit depending, no matter which sector performs well. One or the other, you have money in them all. So you have diversified your asset. Some of you might say, well, why is this important? Well, when you're looking at investing over the long term, Not one particular sector wins every year, year after year, year after year, year after year. Different sectors, whether it be retail, whether it be pharmaceuticals, healthcare, tech, they interchange, and some are at the top some years, some are at the bottom some years. When you have money in all of those different sectors, you benefit no matter who's the top dog. When you diversify your assets, you allow your portfolio to weather whatever storm may come along, whatever sector may perform or may not perform. You give your portfolio the opportunity to reduce risk and volatility and increase the chance of continued performance over a long period of time. Some of you have heard of the term allocation, but then say, well, what's the difference between diversification? Well, allocation is when you actually attribute part of your assets and align them to your goal. Take, for instance, someone who is an aggressive investor and with a long-term time frame. So they say, okay, I plan to retire in 30 years. This person might be an aggressive investor, as long as their risk tolerance is comfortable with that. They would have a portfolio with potentially all equities or all stocks. That is an aggressive allocation. But let's take someone who says, I'm about to retire in 5 years and I don't want to be aggressive because I can't take the risk associated with being aggressive. So they would have less of their money allocated to the stock or equity portion of their portfolio. So they may only have 20% or at max 40% of their money allocated to the stock market. And the rest of those funds would be in something conservative, a mix between bonds and cash, because their portfolio needs to be more conservative since they're going to be retiring in 5 years. Allocation is how you actually split your money up in that pie. So how much is in stocks? How much is in bonds? How much is in cash? Allocation is that splitting of the pie. How do you divide up the pieces? Allocation is just as important as the other pieces of the puzzle we discussed earlier, diversification and investment behavior. Many returns have been lost because clients were allocated improperly, meaning they were too aggressive when they should have been conservative. And our investment behaviors, again, can change the way our investments are allocated, how they're diversified, and when we buy and when we sell. So you need all three of these things together, especially if you're a new investor, because you're going to be, it's new to you. Your emotions are going to be high. So you want to make sure that you have set a strategy, put a plan together in order to maximize your returns, because you're invested properly and you're invested based on your goal, not how you feel. My name is Roderick Jefferson, financial advisor. I've been helping people build wealth for over a decade, and I thank you for watching. Please subscribe, and I hope to see you again.